Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Tim Urbanowicz, Chief Investment Strategist at Innovator ETFs. We have Paisley Nardini, Managing Director and Portfolio Manager and Asset Allocation Strategist at Simplify, Jeff Weniger, Head of Equities at WisdomTree, and Jake Jolly, Head of Investment Analysis at BNY Investments. We're here to discuss how investors should be positioned for shifting global market and macro dynamics. It is great to have everyone with us. Welcome to Trade Talks. A lot to get through. First, we'll kick it off with a recap. Tim, what stood out with you in terms of trends in the market narrative for 2024?
Well, I think 2024 was all about optimism, right? It was an optimism-driven market, whether you look at inflation peaking, the Fed starting to cut, the Fed pausing, most recently, the proposed policies from the Trump administration. And really what that has done is it has made valuations a significant contributor to the big returns that we saw this year. You know, if you look at the S&P, about 60% of the gains there were driven by valuations expanding. The Nasdaq, about 30%. That's significant, right? So now we think it's really about how do we see if that optimism can actually continue to sustain the momentum that we saw this year.
And we're going to address that question for sure. And Paisley, I think one of the other items to address in the backdrop is some uncertainty was removed from the market.
Yeah, absolutely. I would say we got the obvious answer in the room, which was who's going to be our next president in the coming administration. So I think a lot of what we saw post that election result was volatilities subsiding within both equities and mainly within fixed income. I think one major theme that we saw within 2024 was elevated volatility within bond markets. So really seeing that subside with the certainty around who will be in policy. And I think there's a lot of uncertainty still with in regard to Fed results from the rate cuts going forward.
Yeah, and Jeff, that's really something that's going to be key in 2025 and 2026 because the macro economic backdrop is still quite strong.
Yeah, well, and that was the thing, was we were worried about whether or not there was going to be a recession, or at least the market was. And taking that off the table here in 24 was really what got everything bulled up. I mean, the primary risk is, and I don't know if I know the answer to it, is whether or not we've now re-achieved some of those 2021 manic type vibes. There's no NFTs to speak of. There's no Peloton. There's no GameStop this time around. But you do have this rip-roaring rally in the Nasdaq and Bitcoin, and those vibes are certainly there.
Yeah, well, I would also argue, too, that the valuation resets that we saw in 2021 and 2022, focusing on actual path to profitability and governance and clean balance sheets, I think that needed to happen, right? Because it was kind of partying like it was 1999. And Jake, when you think about the macro backdrop in terms of growth, you know, whether you're thinking about the economy overall, the consumer continuing to perform, still quite strong here.
Oh, very strong. So I was actually looking at what the Fed was projecting back at this time last year, so in December 2023, they had penciled in growth of 1.4% this year, right? And most recently in Q3, we put up a 2.8. You know, you look at what we're probably tracking at for Q4, it's close to 3. So it's just been a very, very strong year, right? And you know, when you see that macro growth, you know, it translates into earnings growth. And we've seen earnings this year probably are going to be about 8-9% by the end of the year. That's a strong year, right? So point taken. Certainly the surprise, I think, was the multiples expansion, but it's also delivered on the earnings front. And I think to be a bull right now, you have to continue to believe in that earnings story and that optimism going into next year.
Well, we saw how the market responded in December last year when there was an expectation of 6 to 7 rate cuts, which we did not get, in fact. And to your point, fundamentally, the market did perform. I've heard, expectations of 3 to 5 rate cuts in 2025. Is the backdrop necessarily supportive of that? I think that is one of the key questions, in addition to policy formation, that investors are thinking about heading into the year.
Yeah, I mean, I think the policy backdrop is, there's a lot of uncertainty there, right? This year, I think it was mostly around, monetary policy uncertainty. Next year, it's monetary policy and fiscal policy, right? We think that it's likely to be supportive. The incoming administration is very pro-business. But there's a lot of uncertainty in terms of the sequencing of the policy, which could have ramifications for the macroeconomy, and then also the reaction function from monetary policy. So our view is that probably the rate cut cycle is biased to the upside, so a shallower rate cutting cycle. But we think that growth is going to be strong enough that equities will sort of look at that and say, okay, well, rates might be a bit higher, But this is a macro backdrop that's still very supportive of earnings.
Yeah, and Paisley, you noted as well that fiscal policy is a concern. I would even argue perhaps more so than monetary policy.
Yeah, I think what we look at going forward in 2025 is a lot of these continued tailwinds. I think monetary policy has brought us to this point, has given us that optimism, supported stock markets. I think going forward, fiscal policy needs to take the baton a bit. And so with the new administration, I think you had mentioned, Jake, just thinking about pro-growth, pro-domestic policy, tax cuts potentially supporting continued growth within the earnings sector, and then also from a consumer perspective
Right.
as well, thinking about that continued optimism given the administration that's coming in, and especially some of the nominations that have been made. Obviously, those still need to be approved or appointed, but I think markets took that and ran with it. And I think some of that optimism may start to kind of wane as we get maybe through halfway of 2025, but I think nonetheless, Fed pause is likely the next step in kind of that monetary policy handing the baton and fiscal needing to take over.
And Tim, what's interesting is this particular administration really does bench itself in terms of how the economy and the market is performing, and the expectations that there will be frameworks delivered around certain, emerging technologies and digital assets and so forth, so that the bar is high, but they do bench themselves against leadership and performance.
They do, which I think is really important, and the market has clearly taken that narrative and ran with it, right? I think, to Paisley's point about that baton being passed, you have to see that momentum sustained, right? There's so much good news priced in right now, whether it be, looking at, the potential for tax cuts, deregulation, even the Fed. I think the market just very optimistic on what they're going to see from the Fed last year, just like they were a year ago. So I think the real question is, how much more upside is there with what is expected right now? And I think what we need to be very cautious of, if any of those elements start to disappoint, you see the Fed not cut as quickly as people anticipate, you see any of those policies get hung up in Congress, that could be problematic with the valuation run-up that we've seen, and you could see valuations start to come back down.
Yeah, and Jeff, you also noted M&A activity, IPO, secondary market activity. There's a lot of money that needs to be put to work that's been sitting there prior to the conversation we had before about 2021 and 2022, how it's locked up there. Not only is that good for the financials, of course, but there are a lot of stimulus properties associated with that once that activity heats up.
Yeah, well, up in large cap, of course, you have the big city banks that'll get the M&A underwriting fees. Should that transpire? Now, the thing is, that's street consensus. The consensus is on this M&A boom, and so that's the one part of it. The other part is how many of these regionals will get gobbled up. I mean, we have several thousand banks in this country. I think it's probably no secret that I, among others, believe that there will be a wave of banking consolidation, but it needs to follow through, and you need to have this deregulatory type world come through. Now, the thing about it was J.D. Vance was a fan of Lena Khan. And so the whole thing was that we were supposed to get this easier FTC, but you don't know whether or not it might still be kind of difficult for a big JP Morgan or someone like that to come in and gobble up some smaller players. But these are the Trump trades that are on. We need the corporate tax cut that we were promised from 21 down to 15. We need the SALT tax deduction to keep discretionary rolling.
Oh, I hope
these
so.
For those of us, what's the hottest sector right now besides tech and communication services? It's discretionary. So, hey, I'm in Illinois. I'll take the SALT tax.
Yeah, New York and New Jersey with property taxes, I certainly hope so. But see, that's part of the challenge too, Jeff, until we get more solid ground as it relates to tariffs, taxes, policy, and so forth. It's got to be challenging for corporates to be able to establish their guidance and outlook.
That's right.
Because you don't really know what margins are going to look like and how that will trickle down to the balance sheet.
Well, I mean, think about China, for example, where 16% of its exports are coming to the United States. Is it going to be a 20% tariff, 50 or 100? I mean, Paisley's guess is as good as mine. Tim, your guess is as good as mine. So how do you forecast whether or not it's being long EM or short EM, but also how do you forecast who should be your supplier in 2026 when you don't know whether the tariffs will be moderate or just a negotiating tactic?
Yeah, we also have to think about the dollar as well. I mean, that's certainly going to be influential in terms of not only how it's going to impact input costs, but of course, small caps. I feel like the small caps, Tim, it's like 1, 2, 3, let's go, and then there's just no follow through sometimes with that.
It's head fake after head fake.
Yes.
You had the Fed pause pop, you had the inflation peak pop, you had the Fed cut pop, and then all of them have fizzled out. And most recently, you've had the Trump trade where small caps have rallied. I think to really see that rally sustained, we have to see the earnings backdrop change. Right now you have prices that have rocketed higher, earnings expectations really haven't done much, earnings haven't followed suit. So we need to see that. I think it's positive to see PMIs kicking up, it's positive to see small business optimism increasing. Those are good things that should help lead to that earnings pickup, but we need to see that to get more confidence in the rally. I'd say our stance there is probably more cautiously optimistic than anything else.
Yeah, well, I mean, Paisley, too, when you think about the consumer and the weight with that on GDP and so forth, you know, what happens when margins start to get compressed and input costs go up? It's got to be passed along somewhere.
Yes.
And, you know, consumer debt is pretty high right now. We're seeing a shift in terms of how the consumer's spending.
Yeah, I think that's a huge catalyst for whether small caps can come out of really what this cap that they've had on them for the last couple of years. To your point, we see these blips in small cap performance, and they're very short-lived. A couple of those factors are maybe for a different discussion on just the rise of passive, but I think specifically to what could be a tailwind for small caps over the next, say, 6 to 12 months. I think should the Fed continue on their trajectory of rate cuts, that should boost smaller caps, which are more exposed to external funding. So lower cost of funding, more business, more productivity. I think another theme that's interesting, probably longer to play out, is the trickle down of AI. So these mega cap companies that are producing these AI technologies, should smaller caps be able to adopt them and become more productive with less people, I think that's another reason we could start to see margins either sustain or improve rather than compress.
That's a great point. And Jake, when we think ex-US, what are your thoughts there?
Well, I'll start with U.S. We like U.S. better.
Right.
You know, and it really comes down to sort of the macro momentum, right? I mean, when we look at the U.S., you know, we have economic surprises to the upside. We have this administration coming in, which we think is going to fuel not just business optimism, but at the same time that we're seeing credit conditions loosen, banks with lots of capital to extend. There's just a lot of tailwinds there. You know, yes, there are those headwinds from, you know, valuations, the starting point being very, very high. But when you look at that backdrop versus what we see internationally, and, you know, focus on sort of Eurozone here, it's just a much more challenging backdrop, right? We know that the ECB just cut. The market is expecting another 5 cuts next year from the ECB. Well, why do they expect 5 cuts from the ECB or from that central bank? It's because the backdrop is that much weaker, right? PMIs are pointing to weaker growth. There are obviously some very notable geopolitical challenges there as well. So yes, you know, Eurozone is always pointed as, oh, hey, this is a very cheap market. That is true, but, you know, there are a lot of, you know, macro headwinds, political headwinds. So it's really a region that you can't buy an index and say, oh, it's going to be great, right? Because you are seeing a pretty notable difference between core Europe and peripheral Europe. And peripheral Europe's doing a lot better, thankfully, but don't just buy Europe in one basket.
I mean, sometimes things are cheap for a reason, right? When you think about, you know, high yielding strategies and so forth, there is a reason why they are high yielding. And let's talk about that for a moment here, Paisley. You bring up liquid alts in some solutions here. With alternative forms of financing and not necessarily so reliant on the banks, and you expect credit conditions to loosen up a bit, is there a concern we could return to over-exuberance when it comes to how capital is managed and how it's extended and what's being done with it in product and
Yeah, I think a comment that was made just around the meme stock frenzy, I think a lot of what I've seen over the last couple months is a dislocation from fundamentally driven versus excitement driven. And so I think a lot of things are no longer focusing on fundamentals, even though earnings are strong, more focused on technicals. I think a lot of us are, you know, saying, like, kind of throwing out the window, hey, markets can continue to rise higher. Just because valuations are full doesn't mean they'll stop. And so I think we've seen a little bit of this frenzy, but I do think the underpinning of much of this is still strong fundamentals. And my comment, I would say, looking forward and from an opportunistic perspective, is thinking about how to diversify your risks. I think a comment that Tim made was really staying in the market, but being a little bit more cautiously optimistic. And I know that term is overused in our industry, but I think if you loved that term a year ago, you love it even more today. And so thinking about ways to diversify while keeping your chips on the table, as I like to refer to it, is probably the most prudent way to enter 2025, given what we're discussing here today.
Yeah, and Jeff, you also want to remove some of the correlation risk as well, which is why you're seeing investors look towards different types of alternatives as a smaller percentage of their portfolio.
Yeah, well, there's a million correlations just from 3 or 4 conversations right here. I mean, you think about the ECB and some of those issues over there. Well, what is the correlation that's on right now? Dollar strength with a raging bull market. But you still have this complete upset here where we don't even really have a term for peripheral Europe versus core Europe anymore because France is against the wall. And so in a lot of these allocations overseas, I mean, basically everybody's underweight EFA mandates and EM mandates. But inside EFA mandates, you could do a currency hedge. That's something that WisdomTree is really known for, because there is talk of euro parity relative to the dollar. And if you're thinking about who would end up surprising with aggressive, spur-of-the-moment easing, it would be the monetary union that has political sclerosis right now, where you might wake up to a series of 50s out of the ECB. It's not Jay Powell that would really give us any kind of desperation. The U.S. economy is in rude health.
Yeah, I mean, there's no reason to, right? I think I'd rather keep those tools within the tool chest until they need to be utilized.
Payrolls haven't rolled over.
Right.
Inflation has become tame. The S&P is north of 6,000. What's the hurry?
Yeah, well, and it's so interesting too. I actually, you know how you hear this, the old adage when you start to hear like cab drivers, you know, say, is this stock or is it digital assets and so forth? You know, not to belittle the retail investor, of course, but made the comment that, yeah, well, you know, hopefully when Trump is in, the market will be better, the economy will be better. I'm like, the S&P's up 28%, the Nasdaq's up 33%. This is generational opportunity. So I think back to your point about inflation, there is that disconnect in terms of how investors perceive the economy and what's happening within their 401ks, right?
Yes.
Because inflation might be 0% year over year, but guess what? Was it eggs and chicken everyone's talking about? That's still up 25% in insurance and so forth. So I think investor perception is not necessarily aligned with the returns that we're seeing.
Yeah, I would agree with that. I think another perception perhaps that's maybe even more relevant for some of our conversations with our clients is this disconnect between economic data and the stock market. Right. And if you look at over the last, say, 6, 9, maybe even 12 months, a lot of the leading economic data that we're assessing every single day to make our predictions or allocations within stocks and bonds has been flashing recession. And so I think as we're looking at some of this data and digesting it, it's really hard then to understand how stock market continues to chug along. So I think maybe taking a step back, is the economic data that we're assessing and digesting, is it still relevant?
Right.
Is it still reflective? Is it still responsive to what we're seeing in the markets based on where technology, innovation, and growth is headed? It's no longer the 1970s, it's now 2025. The way that we're capturing data, I think, is maybe a conversation to be had.
I mean, why it's not real time at this point when there are platforms that exist for it to be real time. I mean, even look at the composition of the S&P. Financials, energy used to have more weighting. Now it's, you know, heavily on the side of tech and software and all those names that are driving the market, but you know, maybe the data that they're using isn't the most relevant. I mean, we talk about the inverted yield curve, Tim. I mean, nothing ever came out of that.
No, it didn't. And you know, there are some times where it's a dangerous phrase to say, but sometimes this time is actually different. Yeah. And one of the things I thought was really interesting, you know, to Paisley's point about, you know, keeping the chips on the table, we look at the valuation story, the market trading, you know, 22 plus times forward earnings. Yeah, we went back and looked at 12-month rolling returns at any point in time where the market was at or above that valuation level. Average return of 20% in the next 12 months. So it's very important right now. I think we're using the phrase with our clients, yeah, you want to be risk aware, but you don't want to be risk off. You have to be in, just because valuations are high, valuations are a bad timing tool. You have to be keeping clients invested, but keeping an eye toward these very, in our view, very obvious risks that are going to be playing out in the new year.
Yeah, I mean, Jake, think about it though. If you were to get out of the market with the pandemic volatility and what we saw in 2021, look at the massive upsized returns you would have missed. If you're a long-term investor, this conversation probably isn't, you know, you're not focused on what's happening from rate cut to rate cut as much as you are 10, 20 years out.
Yeah, and one of the charts that we like to roll out to clients a lot is, you know, this bull market compared to all the bull markets since the 1950s. Yes, it's been good, but it's not, you know, out of the ordinary, really. It's been kind of average. So, you know, we look at that and say, okay, yes, it's been very, very strong, but it came out of, you know, 2022, which was a, you know, bloodbath for risk assets. So, you know, we didn't have a recession, but we sort of priced one in. You know, we were down by more than 20%. So the fact that, you know, we're at a bull market that's close to 70% in total returns, you know, to us doesn't scream, yes, again, high valuations, but it doesn't scream to us sort of the end of the road, right? You know, bull markets don't just die for, you know, no reason, right? It would be because the macro fundamentals deteriorate. And when we look at the macro backdrop, it's still very positive, right? And I think sort of to the point around the disconnect between the economy and the market, it's really around expectations, right? Everybody was expecting the recession. We haven't gotten one. And in fact, we've had growth that's much, much stronger than everybody expected. Again, back to the Fed, expecting 1.4% this year. We're almost double that, right? So I think you're seeing that reflected into the market. And I think going into next year, we think it's still a good pro-risk environment, but I would expect it to be a bit more bumpy than this year, right?
Yeah.
This year, the intra-year drawdown is about 8%. That's smaller than during an average year. So next year, I would expect that we're going to have volatility that's going to be a bit bigger.
And Jeff, last word here, but markets are supposed to go up and down. That's how we get averages. So, and there's economic cycles and recession and trough and so forth. So it's not necessarily a bad thing if there is somewhat of a pullback.
And there's ways you can kind of get it out in front of it. I mean, you're talking to me, we just had our models meeting yesterday. We're inching into equities from a greater proportion that we had last month. We're increasing equities. But you can do it if you're doing it in some of these unloved groups. Namely, I don't know if is it blasphemous to say value stocks in this growth cycle. But in 2022, in terms of, okay, you're long and strong, the rug gets pulled out from underneath you. What did not decline nearly as much as growth was value. So you could be overweight equities with a mind to downside protection. It's doing things like buyback type companies and dividend companies. It's not necessarily some of the high flyers right now. But you can be overweight equities and still be on the conservative side.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.